and welcome to Money Matters today. My name is Doug Hepburn, your host with Hepburn Financial Advisors and Cetera Advisors. We offer securities and investment advisory services through Cetera Advisors, LLC, member FINRA, SIPC. Cetera is separately owned from any other entity. My co-host today is Ken Jordan from Round Point Mortgage. Ken, tell me what's great in your world these days.
How are you, Doug?
I'm doing great, thanks.
So we are, the mortgage business is moving right along. Of course, we're dealing with the slowdown in volume. With refinances being off a considerable amount. There's still, believe it or not, Doug, refinances are still 32% of the loans that are being the applications that are being taken right now.
Wow.
Which is surprising considering the rapid rise in interest rates that we've seen over the last couple of months. But I think a big part of that is, folks that have equity in their property and they're looking to take some cash out, do repairs. They're planning on staying there for a while. But it's an interesting time. And I've been saying that probably for the last 24 months, but that hasn't changed.
Exactly. Yeah, I know that, in the past couple of months, we've seen the 10-year tick up to about just over 3%. Mm-hmm. And that's really the basis for the 30-year mortgage, right?
It's one of the benchmarks for sure, and you're tracking, the direction that the markets are going to move. The supply and demand of the mortgage-backed security coupons are really what's going to drive the rates, but they tend to move in similar directions. But bigger news was recently the Fed hike of 50 basis points, which again isn't having a direct impact on interest rates, but it tends to speak to the same story, which is inflation. Right. And I think you and I were talking earlier, some really interesting numbers on inflation, some good insights there.
Yeah, as a matter of fact, we just had a print recently that indicated that I believe, CPI was up 8.3% year over year last month. And we saw core CPI up 0.6% from the prior month. So now, core CPI is your consumer price index. Mm-hmm. That's without food and energy, because food and energy happen to be a lot more volatile than most other goods and services. But from most economists' perspective, the anticipation was a higher print, so it was a little bit lower. Mm-hmm. Because we had some moderation in fuel prices. But right now, from a seasonal perspective, we expect fuel prices to go up because we're entering driving season. It's summertime. People are going to be driving their cars a lot more. And so you're probably going to see fuel prices go up. And what we didn't pick up last month, we're probably going to pick up in the next few months.
Yeah. And now one of the other questions, is wages and how wages are kind of interacting right now with inflation. Are wages really keeping up with inflation at the same rapid pace?
Believe it or not, they aren't. We saw wages fell 0.1% last month, and they're actually down 2.6% over the last year. Mm-hmm. So what that means is people are spending more money on goods and services, but their wages aren't keeping up. And that sort of fuels this discussion of the Great Resignation, as you might have, it's in the news a lot.
Yeah,
very popular term. I have no idea how it's trending on Google, but I'm sure it's trending in a big way because we've got 11.2 million jobs that are unfilled in the U.S. Mm-hmm. And so when people are getting squeezed because their dollar is not going as far, and yet their wages aren't going up, they're more likely to job hop and go to another opportunity where employers need to pay more money. So it's going to be interesting over the next 2 years. In my opinion, I think this bodes for a protracted inflationary spiral, because at some point when a wage price spiral begins, meaning wages start escalating, it's very difficult to slow that down.
Mm-hmm. So, well, the wage increases are good for us, in my business. I mean, what we're seeing right now is we're seeing, especially with the increase in the Federal Reserve. I mean, my borrowers' interest rates on their credit cards all just went up.
Right.
Obviously the prices of housing have gone up. The price of energy has gone up. We work off of our debt to income ratios, but we don't, for a large part, we don't take into consideration gas and electric, as far as from qualifying purposes. But at the end of the day, that's still a reality for a lot of folks. So it's like, prices are higher on the houses, and everything that costs to live in that house is higher. So it's a real vice for a lot of borrowers.
Oh, I'm sure. I'm sure. And, I think what we're going to see is we're going to see a war for talent. So companies are obviously going to have to pay more to get the kind of qualified people that they want, or they're going to have to keep wages. If they want to keep wages the same, they're going to have to expect somebody who's less qualified. So that could have a significant impact on a business. If you're trying to hire people, if you need qualified people, you can't find them. You either got to pay more or you got to accept a lower bar. And so it'll be interesting to see how that pans out. I think, though, for anybody who's entering the job market or early in their career, it creates an opportunity for them to really get on a good track and get into the right position.
And
So
it puts a tremendous amount of pressure on leaders and managers too, to make sure that you're bringing value to your employees and making sure that you're creating the right culture, because company loyalty is at an all-time low. And you need to do what you have to do as a business owner and as a manager to make sure that you're maintaining the relationships with your employees, or, there's other opportunities out there for them.
that's so true. I've always told my business owner clients that the most valuable part of the company is not on the balance sheet. It's the human capital that makes the engine run.
Sure.
And without that, without good players, good people in the right seats on the bus, then, I don't care how good your equipment is, if it's not going to run as efficiently as it should be running or could run.
Absolutely.
So, it'll be interesting to see what happens over the next 12 months with the labor market.
We'll keep track of it.
Exactly. Well, we've got a question from one of our viewers.
Okay.
And so Jansen Thomas of Philadelphia says, what are your thoughts on adjustable mortgage, and has that changed over the past year?
So a lot's changed. I guess let's start with, I'm going to do the other way around. What's changed over the last year is that adjustable rate mortgages, without doubt, are becoming a much more popular option for people who are looking to qualify, because interest rates have gone up. The 30-year fix has gone up, so rapidly. I think that the increase in applications for adjustable rate mortgages is up 10% in this month over last month. And it also represents about 20% of the overall dollar value of being borrowed, which means that the higher loan amounts are even more so looking to that adjustable rate mortgage as a solution for the rising interest rates. A year ago, I may not be recommending adjustable rate mortgages because, of the volatility. But, there's one thing to keep in mind with adjustable rate mortgages. If you're thinking about getting an adjustable rate mortgage, a question is and always has been, how long are you going to be in the house? Because if you're in the house for a couple of years, and we do see a downturn in the market, and all of a sudden you start to see equity loss, you don't want to find yourself in a position where you are in an adjustable rate, it's getting ready to reset, and now you don't have the equity position necessary to refinance. So you really do got to think about it carefully. It's not just about going for the lower interest rate. It's where am I going to be in 3 years? Where am I going to be? Where do I expect to be from an equity standpoint, given some sort of a drop off? And where am I going to be from a mobility standpoint 3, 5, or 7 years out, depending on the product that you're looking at. So they are becoming more popular, but it's not just as simple saying, hey, an adjustable rate mortgage has a lower interest rate, that's the one you should go with. It's something you still got to talk to your mortgage professional about and make sure that you're putting together a quality plan.
Great advice, Ken. That's really great advice. I mean, I guess back when interest rates were lower at historic lows, a few months ago or a year ago, I mean, it made sense to try and fix your payments and fix your interest as long as possible. But now with interest rates going up, people have to go to adjustable rates just to be able to keep payments low and keep up with the increase in the housing costs. Well,
Absolutely.
that's interesting stuff. We've got a great show today and a great guest. Actually, Tim Conrey is our guest from Shear Partners. Tim is a local commercial real estate expert and a veteran of the commercial markets. And he's a former medical researcher specializing in meeting the unique needs of the area's biotechnology businesses. Hi, Tim. How are you?
Great, Doug. Hey, hi, Ken. Thanks for having me on, and glad I could be a part of this show.
Fantastic.
Yeah.
Great to have you, Tim.
So, we just went through a pandemic with lockdowns and work from home. And, everybody's saying, well, our company's going to go back to the office. What's going to happen with work from home? And are we going to see hoteling? That must have really screwed up your business, or at least the commercial real estate market.
Well, it definitely impacted the office market. So I have to bifurcate it a little bit and say that, my area right now is more in the life sciences, which is booming. But I also have a number of clients that are in the general office market, and they're still trying to figure it out. And that becomes a real challenge for a number of reasons. I mean, everyone I talk to seems to be going to 3 days, 1 week, 2 days the following week. A friend of mine, for example, started a law firm a few years ago, moved into a large building and never occupied the space. And his biggest concern is, how do I mentor the younger attorneys that are coming in, and how do I set culture? So that's his concern. If you look into the larger picture, if you look at downtown with firms like Comcast and some of the bigger companies that aren't occupying their space, it has a pretty significant impact. In Philadelphia, for example, there's a use and occupancy tax that funds the schools. Well, if you're not in and using your space, you don't have to pay that. So immediately you've got a loss of revenue to the city of Philadelphia. Well, how are they going to make that up? Well, they're saying now that they're going to increase real estate taxes 31%. In addition to that cost, as more and more firms start to push out space and sublease space, that affects rental rate. Rental rates basically are how you value a commercial building. There's not an intrinsic. It's not like buying a home. It's really based on the revenue. Well, if the revenues start to drop, then the taxes drop on that building as well. And then what backs a lot of those buildings are a lot of teacher pension funds. So now, imagine now you've got teacher pension funds that thought they had a certain valuation, and now that value is dropping. And you get low enough, then there's a catch up. You have to put more equity in. So it's really a precarious situation on the office side. On the life science market side, for example, it's booming. You can't do research remotely. So there's a real strong demand for that. And what we're seeing in that sector, just going back to what you were talking about on salaries, the salaries for an entry-level lab person in Philadelphia, maybe, 2 years ago was about $45,000. That's pushing up to $65,000 a year.
And if you work in a lab, it's not like you can work from home.
And you can't work from home. You can't, you can't do lab research remotely. And the demand in that sector is growing significantly. They're anticipating in Philadelphia 5,000 more jobs over the next 3 years. The they being eConsult, which is one of the economists in the Philadelphia area. And we're seeing that actually trend Boston, San Francisco, San Diego, Austin, Texas, and down in the Research Triangle Park. The advantage right now in Philadelphia is that, they have this thing where they call the poaching rate. So the poaching rate in Boston runs around 30%. You hire 100 people, 30% of them are going to be gone in a year. In Philadelphia, that rate tends to be around 10%. So that's another hidden cost that companies are starting to factor in as they look at these different markets.
No, Tim, it's not just the use and occupancy that's paid by the tenants, but also I believe, it's a lot of municipalities, they have their 1% privilege tax, so to speak, where
Correct.
you work in, for instance, Plymouth Meeting, and you pay your 1%. Well, if you haven't been allowed to work in the office for the last 18 months, then that's revenue that these municipalities are losing as
Correct.
well, as a
Correct.
result of nobody being in the office. And I think that's, there's got to be this big push to get as many people back to the office as possible. But then on the other side, there's this resistance from the folks who are like, hey, work from home's not all that bad,
That's true. I mean, I think that Apple and JP Morgan just announced that everyone's got to be back in the office.
Yeah.
And in the next couple of weeks. So you're starting to see the larger companies just kind of start to demand it.
Now, again, interest rates in my world, obviously they impact the housing market, and interest rates in your world impact the commercial real estate market. So with the increase in interest rates, how has that impacted the real estate market as a whole, the commercial real estate market as a whole?
Well, I think so. It translates into the large investors and pension funds buying buildings. So really, what they're doing now is they're looking a little harder at what kind of asset class they're going to buy, and they're focused right now more on life science and in warehouse. Single tenanted warehouses, and in that instance, you're seeing what they call the cap rate. So the cap rate, as that increases, it decreases the amount of money you're going to be able to pay for a building. So as those creep up, then the sale price of the building decreases, which means the returns start to decrease for the owners, and so. I think that right now there's a little bit of a stagnation when it comes to those transactions. And so those deals haven't been done as quickly as maybe they would have been, in the last year. But again, that there's still a lot of money that's in the market and it's got to go somewhere. So I think there's still a lot of liquidity right now.
Yeah, that's interesting. Back to the pandemic, though. I mean, we talked about the whole work from home situation and when do you return to the office and how employers actually deal with that. But one of the other things that came out of the pandemic is that people were doing so much online buying, and it really changed, and so much stuff on the internet that it really changed kind of the mix in the economy. How has that affected commercial real estate?
Well, it's had there's a couple ways that's impacted the real estate. So you've got the companies maybe 5-8 years ago in e-commerce that were acquiring large, you're looking at 800,000, 1 million square foot warehouses that people like Amazon, Wayfair have acquired. Well, now the push as we demand a quicker response and quicker delivery times, we want everything the next day. The way they met that market is by having smaller warehouses for what they call last mile delivery. So as you got in closer into the urban areas for these last mile warehouses, they're gobbling them up. And there wasn't that much of a vacancy or availability, and it's really tough, especially in the Philadelphia area. So what does that mean? You have high demand, low availability, so the price is going up. So 5 years ago, maybe you would rent a warehouse in the Philadelphia area, metropolitan area, at between $4 and $5 a square foot. Well, that's now $12 to $15 a square foot. So that's a huge movement in rental rate, which then translates into a pretty good significant value in terms of buildings. And of course, you have owners starting to sell those buildings.
And of course, 5 years ago, the hot commodity was buying or building large warehouses near huge interstates like Lehigh Valley, out in Camp Hill and Harrisburg area, York. Anything that was along an interstate just got snapped up or developed. And so now what you're saying, I guess, is that they're buying much smaller places that are in neighborhoods or relatively close to.
Yeah, now the big companies are looking really hard to try to get in closer into Philadelphia. I mean, you don't hear it that much, but Amazon they literally bought an apartment building in West Philadelphia that's strictly they didn't even really demo the interior of the building. All they're doing is storing packages there, and it's in an area where these small pickup trucks can come and pick up and do deliveries into the neighborhoods in Philadelphia and give them that last mile. And if you want your Tide or your toothpaste the next day, you're getting it, and you're getting it from these smaller infill warehouses that you see in Philadelphia, for example.
They just keep an inventory of the most popular items, knowing that there's going to be, X demand for those items to be delivered in the next 24 hours or so. And that's interesting. That's a segment of the market that wasn't even on my mind. All this talk about office space, and how the pandemic impacted office space, but
right,
the whole flip side where people are actually doing, commercial real estate's doing well in a lot of ways as a result.
In certain sectors, it is. That's correct.
Now there's a term, I feel like every time Doug and I talk, we use this term supply chain, because there are supply chain issues and it's affecting the ability of residential real estate to be built. But also I'm assuming that the supply chain issues that we are facing are also impacting commercial real estate when it comes to development, leasing, new construction of properties. Is that the case, Tim? Is that so?
That's significant. I'll give you an example. I have a client that has a wine import business. It takes him 3 days to have the wine shipped from Italy to New Jersey. It takes him an extra 2 weeks to get it off the ship and onto the dock because they're so backed up at the ports. And then it probably takes him another week for a truck to come and get that and take that out. So what it's forcing him to do is handle more inventory. So he's got to have a higher inventory. He was telling me his inventory right now is double what it was 5 years ago, for fear that he's not going to be able to get inventory and get product in fast enough. So what that means now, he's got to go out and find more warehouse space, right? So now your demand for warehouse is going up, and that's happening in all the major urban areas. So that's one example. Well, the other example, though, on supply chain is we were just hired by a company, and they want to build a 150,000 square foot lab research building. They haven't even planned the building yet, but they've got to put their order in to buy all their air handlers, but basically their air conditioning, right? All their air handlers, they got to place that order now before they've even designed the building, or else they won't be able to get their equipment in time. So the lead time on those items are running 36 to 40 months. And part of it is not only is, a lot of the electronics that are going into it comes from China. So every time China shuts down because of their pandemic or shuts down their port, it drags on our ability, or the US's ability, to be able to have air handlers and things like that go into development. If you, for example, are, and we see this in life science because the energy or the electrical demand is higher. If you buy a building and you need to increase your electrical supply, for example, that's coming into the building, that's probably right now running about a 48-month delay. So imagine that you have a business, you're expanding it, you're trying to meet the demand of manufacturing either a new new cancer therapy or a drug, and you can't do it now for 48 months. And let's say you have a patent on that. So now your patent's going to start to run out, and you can't get your product into market fast enough. So it's really been a huge weight on trying to move this market forward. And so what we hear often anymore in most sectors is speed to market. Where can I get into the market the fastest? And the decisions are made such that you pretty much have to have a building that's ready to go, and it's really pushing the prices up on a lot of these buildings.
I bet.
That's interesting. When you were talking about the inventory issue with the wine merchant, it made me think that needing that additional inventory space and warehouse space, he's going to have much higher working capital needs. Now he's got to draw more from the bank. Bank's making out.
Right.
But with rising interest rates, at some point that's going to be curtailed.
Right.
So the ripple effect continues.
And his employee base in the warehouse
Uh-oh. I think we may have lost Tim here.
It sounds that way. Here's what I heard, Doug. I heard that if you wait long enough, we're going to have some discounts on wine and air handlers.
Yeah, exactly. We either
Yeah.
or buy them and sell them on the gray market, right? So
Yeah. All right. Tim's back. And the other thing that I heard is that with the demand for in town warehouses, I mean, a lot of these old industrial plants were really being converted to apartment buildings, and now you've got people who are doing multifamily stuff, which has been behind the curve for a long time because we're not building enough units to keep up with demand.
right.
But you've got those people competing now with the last mile guys who are trying to buy whatever they can to turn it into a warehouse. So
only exacerbating the housing shortage that we're already facing.
Right.
Which is driving up rents and driving up prices on homes, which is
right.
Exactly.
You're right. It is a ripple. It's a ripple.
Yeah. Yeah. Well, as the old Chinese curse says, may you live in interesting times. I think you're there.
Yeah.
Well, Tim, thanks for being here today. This has been a great show. We appreciate your insights. I just want to thank you viewers for tuning in. One thing I forgot to mention is that, if you have a question, you can send it to Money Matters TV. Here's the information on how to ask your question for our show.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, that's it for today. We appreciate you tuning in. Our next guest is going to be Rachel Bushy, Esquire, from Troutman Pepper, and we hope you tune in for that. In the meantime, come back and see our other shows at Money Matters TV, because your money matters.